Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. I think all eyes are on the S&P 500 after it has rejected off its 200-day moving average. Now, I'm going to do a quick comparison here as just an introduction to this video. If we go back in time, one of the last big rejections that we've had off the 200-day moving average, it was in 2008. In 2008, this bear market rally right here was triggered by a Federal Reserve FOMC meeting where they announced that they would be easing monetary policy significantly, and so the market started to rally in anticipation of the recovery that we'd see in the economy. Of course, we all know what happened. The S&P 500 got rejected off the 200-day moving average before plunging down a staggering 53% off that level. Now, if we fast forward to this rejection occurred as we saw stock market earnings deteriorate in a big way, and investors realized that the economy was going to slow down a lot more than what was currently being priced in, and that you weren't going to see this recovery in the stock market. So if we fast forward to today, we obviously know that this rally here was triggered by an FOMC meeting back in July. The Fed started to adopt a little bit of a less hawkish tone, and so that triggered optimism in the market as investors are already anticipating that the Fed is going to eventually pivot and once again be a tailwind to the market, which really has not been the case throughout 2022. Now, what's happened just over the past few trading sessions, we've had a rejection of the 200-day moving average. So this is concerning a lot of people, and these are very legitimate concerns. This is a big moving average that has acted as support many times throughout a bull market. This is something that investors pay attention to. So the question is, how does that fit in with what we've been saying, with all the research that we've been providing throughout the past few months, which has actually been very optimistic? The combination of inflation slowing down, economic numbers slowing down, the 2-year yield potentially beginning to roll over. We think we're at that part of the cycle where monetary conditions are going to be easing. And you can see what happened the last time monetary conditions were easing was 2019, and that triggered a lot of optimism in the market. And in fact, this has been what the rally has been about throughout the second half of 2022. It's been the market front-running these easier financial conditions. At least that's our opinion and our take on what's going on in the market. So how does that fit in, and how does that compare to what was going on in 2008? Is it as simple as just paying attention to this rejection of the 200-day moving average and concluding that we're going to be in the same situation as 2008? By the way, if you enjoy this video, don't forget to smash the like button. It really helps push out our videos to more people. It makes the effort and the time that we put into making these videos, it makes it all worthwhile. So thank you very much for doing that. And also, if you are new here, don't forget to smash that subscribe button if you are interested in following these crazy markets with us. So let's highlight some of the key differences that we have today to this rejection of the 200-day moving average on the S&P 500, because this is not the only moment where we saw a rejection, right? You can spot quite a few rejections here. For example, in 2010, rejection of the 200-day. Again, in 2011, you had a rejection, but eventually the market did move higher here in this 2011 example. In 2015, you did have a rejection retesting the low, but eventually the market did resume higher. Again, in 2018, you had the market reject in a big way here, which did trigger another move down in the market, but stocks recovered. You can't say this is similar to 2008. The first difference between this rejection and this rejection is that we're at a very, very different moment in the Federal Reserve cycle. Right here, you can see that the Federal Reserve was already easing significantly. The economy was already heading downwards in a big, big way in that example. That's not the case today. We haven't seen any easing. We've only seen tightening from the Federal Reserve. So that's a lot more similar to these areas and these areas than what we saw in 2008. And the way I like to think about that is that the Fed has a tremendous amount of power to boost the stock market, even accidentally, during a tightening cycle. And what I mean by that is that this entire correction here has been fueled by the Fed tightening. So if Powell decides all of a sudden that he wants to cut rates to zero, the market is going to go on an absolutely massive run as investors price in easy monetary policy. Now, of course, that's not going to happen, but the point is that the Fed has power. There is this potential energy, we'll call it, potential energy for the Fed to back off the brakes and for the market to rally during a tightening cycle. And that's why you tend to see big rallies in the market following a pivot. Just as an example, June 2006, big rally, and right here in December 2018, big rally. And that was not at all the case right here, because the Fed was already easing leading up to that rejection. So the market had already priced in a lot of the easing. Everyone was already aware that money was getting easier, that financial conditions were loosening. And so you didn't have the same setup here for investors to get optimistic as you do here and start to look forward to easier financial conditions. That just wasn't the case here. And it wasn't until they announced QE that the market really bottomed and started to rally and recover. And in fact, that leads me to the second big difference, and that is the unemployment rate. If we take a look at the unemployment rate in 2008, leading up to that rejection, look at what the unemployment rate was doing. It had already been rising for months, and it was accelerating significantly to the upside, which is just not what we have today. Right here looks a lot more like what was going on in 2006 with unemployment going down, or December 2018 where unemployment rate was going down. It doesn't look like this. Now, putting the macro aside, let's take a look at the market dynamics and see one big difference between now and 2008. The chart I'm about to show you is from an update that we posted last week on our website. It's from an SP 500 overview that we posted on our website last week. And we highlighted this iconic chart of the breadth, the SP 500 percentage of stocks above their 50-day moving average. We've discussed that many times on this channel before, but seeing the breadth go from very low, right, very oversold, to very overbought, and I believe this was a 90% reading with 90% of stocks above their 50-day moving average. It shows a lot of strength. It shows a big recovery in the market and a significant shift in the behavior of the market. And what's interesting, if I zoom in a little bit here, is that you do not get these readings during a bear market. You don't get that optimism. And you can see here the 2008 rally, the 2008 bear market rally, when the market was rejected off that 200-day moving average. You didn't have a breadth thrust. You didn't have this big optimism that we saw in the recent rally. And the same thing applies to the 2003 bear market, where you did not see the same optimism. It didn't reach those same levels throughout that entire bear market, showing you that investors were not confident at any point during the bear market, not confident enough to trigger that type of behavior in the market. And you can see, just looking at these red dots, these very often correspond to the beginning of major rallies in the market. So that's, I think, another key difference between today and 2008. Just looking at this very objectively, could this be the first time that this signal gets invalidated? You know, absolutely. And that's what I try to remind investors as much as possible, is nothing is 100%. You're always going to have to take a bet somewhere. The key is to put the odds in your favor, right? And that's what we're trying to do by looking at all this data, all these charts, is to put the odds in our favor as much as possible. And then we have to make a judgment call on how much risk we want to take. There is always that possibility that this ends up being a false signal, and that this is the first time that we get this breadth thrust during a bear market rally. And 2 years from now, after a massive bear market, we'll look at this reading as probably one of the worst bull traps in history. Right? That's possible, and something to keep in mind when you're adjusting how much risk you are taking. Now let's dive into the shorter term technicals. I'm going to try and post this video before Fed Powell speaks at the Jackson Hole meeting, because generally that does trigger a pretty large market reaction. and this video, in terms of the price action, may be expired by then. Now we're seeing an interesting dynamic here leading up to this meeting, and that is that the stock market has been rallying significantly off the low since June and has been pricing in a relatively dovish Fed. It's been front-running easier financial conditions, that's for sure. And we can see that by just taking a look at the valuations of the S&P 500 recently that have moved higher, right? So the only way you can get a surge in valuations is because of easier monetary policy or lower bond yields. Same thing that happened in 2020. Very easy monetary policy was announced in around March of 2020, and that triggered this major surge in PE ratios straight away. Immediately, investors were able to price in the easier conditions. And again, here in December 2018, the Fed pivot that we talked about earlier triggered this recovery in valuations because market participants were able to price in an easier Fed policy. So this is what has been happening here. The market has been pricing in a dovish Fed, and that's despite the 2-year yield that I'm going to put up on this chart here. The 2-year yield that's been rising, right? So you have this combination of the stock market being well off its lows, well off the June lows, but the 2-year yield, that's basically, I like to summarize it as the anticipation of the Federal Reserve and the market expectation of what the Federal Reserve is going to do. It's at the all-time high, right? It's trending higher. So there is this disconnect, and you can see here 2-year yield top coincided with the bottom of the stock market, and right here we're kind of retesting that high on the 2-year, but the stock market is not at all retesting that low. So there is this disconnect here between what the bond market is pricing in and what the S&P 500 and the stock market in general is pricing in. Now, again, I don't like to make predictions on the short-term price action. To me, in the short term, it does suggest that the market is vulnerable to being disappointed. If Jerome Powell ends up being very hawkish and that the 2-year yield ends up being right about the interest rate hikes and what the Federal Reserve policy is going to look like, well, you could see this price channel break down and the stock market to retrace part of this move that it front ran. Now, of course, there is also the possibility for the stock market to be right, for Powell to come out with a 50 basis point hike and sound very dovish, start to talk about the economy weakening and the fact that they've made progress on the inflation front. And so in that case, you'd see the 2-year rollover break down and the stock market break out. Now, we think a Fed pivot and a rollover in the 2-year is very close. So if we do see a pullback in the market here, right, which is not a given depending on what Powell says in this meeting, but if we do see a pullback on the following the Jackson Hole meeting, we think that would lead to some pretty big buying opportunities because we don't expect to have to wait very long for the Federal Reserve to pivot. And considering this breadth thrust signal that we highlighted just a couple of minutes ago, it seems like the market agrees with that, right? It seems like the market has also concluded that a Fed pivot is not very far, and that's already been priced in, right? So unless you have some big inflation shock that comes, that happens, or the Fed ends up staying hawkish despite rapidly weakening economic numbers, unless that happens, it does seem like the market is getting optimistic on the Fed pivot. In all of these cases, the market did not revisit the previous low, right? None of these rallies had a retracement all the way to the previous low, which is right now what we're betting on, right? We could see a little bit of a retracement that's definite if the market gets spooked, but we think the June low is going to hold and that eventually you are going to see that downtrend line break out. Now, of course, through these updates that we post regularly on our website, we'll be keeping you guys updated on everything that's going on in the market, seeing if any of these signals get invalidated, what's happening underneath the surface, whether there's a certain risk reward that's deteriorating and what potential entry opportunities look like, and also potential exits and targets along the way. We don't just cover the stock market, we cover all assets where we believe there could be an opportunity, whether that's the bond market, precious metals, stocks around the world, commodities, cryptocurrencies, and we are always looking to hedge our bets from an investment standpoint. For example, currently looking at a short investment setup on crude oil and an accumulation process in long-dated treasury bonds that currently seem to be forming a bottoming pattern. Now, all of these are regularly updated on our watch list. Now, all of these trades and investments are regularly updated on our watch list, where we update the most recent posts with our targets, entries, the key levels to watch, and also continuously reevaluating our thesis along the way. So if you are interested in checking out our website, make sure to click on the link down below and access the free trial to our service. You can test out the ins and outs of the service we provide. I'm sure you guys will enjoy it. Now, speaking of reevaluating the thesis, I think that's always very important. And I want to give the flip side of the bullish case, because you can be very optimistic on this rally as market participants front run a Fed pivot or front run easier financial conditions. But one of the things that caused the rollover in the 2008 financial crisis are earnings, right? The earnings outlook. And we've already had a few disappointing earnings this season, so that remains a big risk. You can have all the easing you want. If earnings are not holding up, or they're not strong, they're not growing, you are going to see the market correct. And 2008 is a great example of that. You have all the easy money you want, but earnings are collapsing, and so the market is collapsing. And that's what a lot of people are currently waiting for right now, is for earnings to start moving lower. So that's something that we'll be reevaluating in an article next week, and along with that, reevaluating the 5,200 to 5,300 point target that we've previously talked about on the S&P 500. Now, as a quick teaser from the research, the shock in monetary policy that we had throughout 2021 and throughout 2022, that is going to lead to potentially a decline in earnings similar in magnitude to what we saw in 2000 or 2008, right? That's something that you could expect. But from what we're finding so far, and again, we'll be posting that next week, but there is a lag time between tightening of monetary policy and when that is reflected in earnings, and it's quite a big lag time. So unless we find other reasons to believe that earnings should fall in the near future, unless we find other reasons, we should remain relatively optimistic on the market until around Q2 of 2023, which sits around here. So between now and Q2 of 2023, the market could just be looking forward to easier financial conditions and not yet be looking at a big deterioration in earnings. But again, perhaps I am getting ahead of myself. We'll be talking about that in detail next week. If you enjoyed this episode, make sure to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading, and see you next time.